We are live.
All right. Welcome back, everybody. I am Zachary Van Ness. This is Jeremiah Conger. We are with Annuity Association, bringing you another episode of I Love Annuities podcast. First of all, I want to say thanks for coming and joining us. Feel free to jump in and subscribe so you can get more content from us. Today, we'll be jumping into understanding fixed index annuities with guaranteed income riders. So we've talked about different annuity types so far. We're going to dive in deeper to one specific type of annuity today.
Absolutely. Thanks, Zach. Yeah, there's one thing that he forgot, and that is that we are the Annuity Dudes.
Oh.
So thank you for tuning in to the Annuity Dudes. I Love Annuities podcast is where you're at. We're happy to bring some insightful information. Like Zach said, we're going to be talking about income riders and explaining them in detail on how they work, what the features and benefits are, what the nomenclature or terminology is that they use to explain the way that they work, and then giving you some real life scenarios of how income riders are commonly used to help people solve the income need that they have in retirement. We're also going to be talking about some of the misconceptions around income riders and how they're often misrepresented either by agents or advisors, and even how they're maybe misunderstood by consumers.
That's right. So just from an understanding of our business model and the way that we approach this, we're an independent advisor. And from our end of it, we work with all carriers out there on the market. So our main priority is to provide you with the education of the annuities so that when you go into this, and whether you're meeting with somebody you've met with before or meeting with us for the first time, you've got a baseline education so that these terms that are being used aren't flying over your head, and you've got a better understanding of how to approach these. So let's jump into it. Let's get in and say, what is a fixed index annuity with an income rider?
Yeah, so let's start with the basics. A fixed indexed annuity is a type of annuity that offers protection from market downturns while allowing your money to grow based on the performance of an underlying index like the S&P 500. The income rider, however, is essentially a contract and a feature that you're adding to that purchase of that annuity that's going to guarantee an income stream for the rest of your life, no matter what happens in the market. And it's a powerful way to create essentially a personal pension. Think of it as creating a retirement income insurance policy. It's ensuring that you'll never outlive that money that goes in there. And as with all financial tools, there are some important details to consider, and that's what we're going to dive into next.
That's right. Yeah. So, and just to confirm, this rider that's attached to this contract, that's guaranteed. It's not going anywhere.
Yeah. So the income rider contract is guaranteed by the issuing insurance company. So obviously it's important to know which company you're working with, who's backing that annuity contract, and, ultimately what their track record is and their history of being stable and being able to continue to deliver on their requirements from an insurance company perspective.
Yeah, and like Jeremiah had mentioned, what we'll do is we'll take a look at some real life scenarios. First, get you some education on how these operate. So by taking a look at that, what we have found is a lot of terms that folks haven't heard before. And we want to introduce you to that and take you through a process that we take all of our clients through in understanding these key terms. So Jeremiah, if you want to take over and show what we use.
Yeah, absolutely. To touch on those terms real quick, I think it's important to cover, and just if you're taking notes, which I highly recommend since this is more of an educational based video or podcast episode, some of the terms that you're going to hear when being presented or positioned an annuity with an income rider are going to be things like the roll-up rate. You're also going to hear the income rider fee or charge. You're going to hear income benefit base or income benefit value. You're going to hear payout rate or payout factor, or what also is sometimes referred to as the withdrawal rate. And you're going to hear a bunch of other features that are associated with that type of annuity with an income rider, but we're going to be breaking down those core features just to really give you some high level definitions of what they mean, and then also giving you a really easy way to kind of assess the product itself and know exactly what to look for in order to make a good decision. So when you think of an indexed annuity with a guaranteed income rider, when you add that guaranteed income rider to this contract, you're essentially creating two values that are independent in most cases from one another within that one contract. So the way that I break it down is relating it to a T chart. So if you are taking notes, go ahead and draw a T chart out on a piece of paper. And I have a whiteboard exercise that I've used in a previous Zoom meeting with our clients, which I'll share here as well for you to look at. And please forgive me because it does look like a kindergartner wrote it. I was using my mouse to draw it out. So hopefully you can still read what it says. But when you think of a income rider being added to this annuity contract, you're essentially creating two different values within the policy that are tracked and regarded as independent from one another in most cases. On the left-hand side of this T chart, you have what's called the account value. And the account value is essentially your initial premium investment plus any interest earned on a non-guaranteed basis. Okay, on a non-guaranteed basis. On this account value, you do have a guarantee of principal protection. So remember the word annuity, I often ask our audience to refer to that word annuity as guarantee. And it just comes down to what type of guarantee are we getting in the specific annuity type that we're interested in. And in this case, you're getting two different guarantees when you add on this income rider. The first guarantee is on your principal protection, which is going to apply to this account value side on the left-hand side of this T chart. So your principal's protected. That initial premium investment can be allocated to a number of different index crediting strategies that are offered within the contract. And just know that your money is protected. It's not directly invested in the market. It actually just sits off on the sideline, but there are indexes that are used to gauge the performance and how that interest may be earned over time. We do say that that interest is earned on a non-guaranteed basis because there's no guarantee of those indexes performing, no different than your 401k or your stock account. We don't know what they're going to do day to day or year to year. That's no different in the indexed annuity. But the guarantee does happen to fall around the principal protection, which there is no downside risk in the event those associated indexes were to perform negatively in any given crediting period. On the right-hand side of your T chart, that is where this income rider is coming into play. So you're going to have this income benefit account, essentially, that is where another guarantee is being bolted on to this contract. And this guarantee is centered around how that initial premium investment grows on a guaranteed basis over time. Oftentimes, when people purchase indexed annuities with guaranteed lifetime income riders, they're planning to defer that money for a period of time. So some scenarios are, maybe a 60-year-old person that's still working. They plan to retire at 65, but they want to shield that asset from volatility in the market and give themselves some peace of mind, clarity, and confidence that their income is going to grow on a guaranteed basis and essentially creating or eliminating rather the uncontrollables of the market. So the income rider gives a guaranteed rate of return or growth on that initial premium investment. And it's very powerful because that person knows exactly how much that income will be at the time they go to retire. And it's a great way to eliminate the sequence of returns risk or unfavorable sequence of returns in the markets. Now, some of the income rider contracts that we're seeing today, being an independent annuity advisory company here at Annuity Association, we scour the entire marketplace and look at the most competitive offers that we can find for our clients. And on these income rider roll-up rates, which is what they define as the rate of interest that's being applied to that initial premium, We're seeing those anywhere from 7 to 8% in most cases. But what I will tell you is don't get so caught up on what the actual roll-up rate is. And I'll explain what I mean by that later on in this video. But there are going to be a lot of terms that you hear, a lot of words and different fancy buzzwords, if you will, that are going to be used and positioned to you by agents and advisors. But those buzzwords don't mean anything. What matters most is what is the bottom line? Who is going to pay you the most amount of guaranteed income at the time they state they'll pay it? So if you're planning to defer 5 years, and that, as I gave in that example, what matters is who's going to pay you the highest amount. It doesn't matter what the roll-up rate is necessarily.